Anyways, let's get back to business, turn to investment strategy now. And of course, after his fund returned more than double in 2020, our next guest believes there is more upside to come, fueled by ultra-low interest rates, fiscal stimulus, and consumer spending. Oh, welcome back to Ausbiz for 2021. Michael Frazis from Frazis Capital Partners. Hey, Michael, welcome to the program. We'll talk all of that in just a moment. I know that you're really across the space, the healthcare space in general. We had Eli Lilly out last night getting a big boost after coming through with some results in terms of Alzheimer's. Curious to know if you follow Eli Lilly.
I have been following the Alzheimer's story. So the background to that is there's when people first started learning about Alzheimer's, they realized there's a lot of plaques in people's brains. And there was kind of like a causative assumption that those beta amyloid plaques cause the disease. But there's been several hundred drugs that target those plaques, but don't actually cure the disease. So last year, obviously, there was Biogen, and there's still a lot of controversy over that drug. To the extent that some of them might work, they're kind of they're very marginal. It's very hard to tell if there's any benefit at all. Eli Lilly was a very small study, it's about 275 people, and they're targeting that same pathway. So I'm usually optimistic on biotechs, but on this one, my guess is it will follow the same path as the many other drugs targeting that pathway and probably not work. It's probably a bit more skeptical than you might have been expecting.
Yeah, maybe, but it's a complicated disease, but I think we all have something invested in getting something sorted for it. So Michael, are there any other sort of stories in that biotech space bubbling away that are really interesting you as we move into 2021? I mean, we've got Moderna. We know your view on that. You've done so well. But what's next? Because we always want to know what's next.
Yeah, it's a tough one. I mean, we try and focus on companies that, I guess we try and avoid some of the typical biotech traps. So a typical biotech trap will be there'll be 20 or 30 companies going for the same condition. And hopefully one of them will cure it, but sometimes more than one of them will actually find a treatment. But only one will be able to capture the market. So you might have 10 to 20 stocks, all of which are valued on some 40, 50% probability of success. But really most of them are going down and actually going to be value destroying. And obviously that's, for society, that's good. All this investment, all these different approaches targeting the same disease, that's what actually guarantees that there's a good chance that somebody cures them. But where we're looking now is companies that are focused on ultra-rare diseases in conditions where there's basically no competition. And if they do kind of succeed, then they will actually win that market and be able to do the next one. So one of our recent picks has been Ultragenyx. So they brought 4 treatments to market, so 4 FDA approvals, which is astonishing over 10-year company lifetime. And they'll be able to take those revenues that they're already making from those conditions to fund the rest of their pipeline. So a few interesting platform ideas like that. But I think it's going to be a good year for life sciences. Investors are so interested in the space. There's money pouring in, and there's been some really leaps in the foundational science that makes it all happen.
Michael, Mesoblast, it's a biotech that gets a lot of attention here, a very volatile stock. Do you have a view on MSB?
MSB, it's a tough one. So I always thought that coronavirus treatment should be somewhat effective. They've obviously got a heart and a kind of back pain condition. The FDA is they've got 2 misses from the FDA already. I think it's a tough path from here. It's a company that typically announces something positive, then raises lots of money, and then does that again and again and again. The core technology is these mesenchymal stem cells, but the IP around that's kind of blurry. I find it a difficult story, so we don't have a position.
Michael, now I know that you're not necessarily that interested in big tech, but we can't ignore it right now, partially because of the rotation that's been happening lately from growth into other areas of the market, but also now because we really do have this specter of regulation. We've got these big tech companies being accused of censorship and everything else, rightfully, wrongfully. Putting that aside, if we do see regulation of the big tech in the US, does that have a trickle-down impact, and how so for some of those companies that you may be interested in or more interested in?
Look, it's probably good for the kind of up-and-coming next-generation companies that we go for. An example would be like Alibaba in the US. So we're obviously long Pinduoduo, which is kind of the upstart that took 10% of their market share in a few years and now is much more. When the regulators go for the bigger companies, it actually kind of opens up space for small companies at the bottom. So you think about what's happening with Facebook. So Facebook Messenger Instagram are becoming increasingly blurred, increasingly one product. You know, the messaging is aligned, they're sharing data. That actually opens up space for new kind of businesses and new messaging apps. A lot of people downloading Signal, for example. So in general, like the regulation there is probably good for the ecosystem more broadly. You know, it's probably good for the companies. You know, if Google was broken up and YouTube was a separate business and you know, Maps could be a separate business, you know, there's so many different, they're kind of conglomerates, which means there's like whole layers of management that probably don't need to be there. And it also means they can't, you know, I guess the environment there has been stifled. You know, if you want to advertise, you have to go to Google or Facebook. That's probably not good for anybody. So I think the whole thing's really positive for the kind of next generation. I think those companies, you know, particularly Facebook, has probably kind of reached a point where they've kind of saturated everybody with so many ads. It's going to get harder and harder for them to post the growth numbers that they have. Yeah, I think all up, it's good for the ecosystem, it's good for society, it's good for the economy, and it's kind of good for the companies that we're investing in. So
Michael, just to go and finish off, I just want to get your view. You go and invest in a variety of different markets. Like, your investment universe is massive. How do you go and screen, without giving away your secret sauce, how do you screen for opportunities of companies that you like and don't like?
Right. I think one thing we've done quite well in finding these things is start the opposite spot where everybody else does. So most people try and figure out like what's going to work, what is the next big thing, what's going to have a good year next year, what's going to beat the next quarter. We're kind of the opposite. We're like, okay, what has twice as many users today as it had last year? Like, that's interesting. And then if a company's doubling in size over a year, you know, we'll try and understand that. But we'll take that as fact. You know, there's so many people that we'll see a company growing at 100% and just be immediately skeptical. You know, something must be wrong. We'll start, okay, this company's doing something interesting. There's probably something there. Whether or not it's investable is a different question. But I think starting at that end has been so much more productive, and it's really got us the right answers. You know, Afterpay, Tesla, Pinduoduo, you know, kind of 20 companies or so that have, you know, done extraordinarily well. So I think starting from the opposite end has been really, really helpful.
And Michael, just a quick one to finish off. Sorry, Scotty. Do you feel spoiled for choice right now in 2021, or are things getting a little bit tougher to find those opportunities?
We are finding quite a few new ones, and we're kind of expanding the portfolio to do it. I mean, obviously, you know, we're up over 100% net last year. Things have run really hard, but we really have a very diversified portfolio. You know, we have over 40 stocks. And as we're seeing new opportunities, we're not necessarily selling out of existing positions. We're just kind of adding them to the portfolio. So we think we have a really kind of diversified exposure. You know, the weighted average organic growth rate across our portfolio is now over 80%. So if you've thought about all the places to put your money, having it in 40 to 50, you know, extremely fast-growing tech and biotech companies, the forefront of technology, you know, I think that's one of the, safest is probably too strong. We're probably one of the best places to put your money. And that's certainly where we're putting all of ours.
Michael Frazzis from Frazzis Capital Partners, thank you for joining us on the program today, and enjoy the rest of your day.
Thanks so much.
See ya
Next time.